Okay, it's 10 a.m. It's Tuesday, and we have a special guest, David McKnight, as you can see, in studio. So this is the first time I've done this. We're having someone in studio. I really wasn't sure how it was going to be, and I guess we won't know until it's all done. But I hope y'all can hear us okay. We've done a couple sound checks, and it seems to be okay. But say hi, Dave.
Hey, folks. Glad to be with you, Mark.
Yeah.
Appreciate you having me.
We've seen a lot of each other.
Yes,
This
indeed
year.
we have.
Yeah.
Indeed we have.
Yeah. So you had an event, a training event in January, and then we were both at Ed's event a few weeks ago, and then again last week. So,
Right.
and here we are today. And I'm super excited. You all know that today is May 16th. And tonight at the Newtown Theater at 6:30, we're going to have David McKnight and Ed Slott, two of the most important thought leaders in the retirement planning space, in my opinion, and a lot of people's opinion. And they're going to be on the same stage for the first time. I say that jokingly because Dave and Ed are going to be together in Chicago for the next several days this week. And that's going to be a great event for a lot of people. You've got a couple hundred or 300 people coming to that. And that's more for financial professionals. But this is for you folks, consumers, folks who need this information. And you've got two of the best coming tonight to talk about what you should be doing today to set yourself up for best chance of success. So we have a lot to talk about today. I want to have to remind you, because we're on YouTube, to hit the like, subscribe, and notification button. And we're going to have a different format. So we're not going to do our slot updates today. We're not going to do the market updates. We're just going to chat. And Dave and I sat this morning and we said, okay, what are the things that are important that we should talk about? So we've got a list of things. And of course, if you have questions, ask questions as we go along. Dave's going to be monitoring the chat on the screen there, and we can ask or answer questions as we go. So let me first give you a little bit of Dave's bio. I know you all know him already. You know, I meant to grab your books. So on the way into the studio here, Dave said, hey, you got some great books here. And he was talking about his book, the Power Zero, Look Before You LERP, Tax-Free Income for Life, Volatility Shield. I'm so sorry, I'll get it. The Infinity Code. Yes,
That's
yes,
right.
yes. But they're all here. I keep them not just for our reference, but often I hand them to people when we're in the office because they're so beneficial. And I don't know if you noticed, Dave, but we have a little library out on the parking lot, and a little free library is a place where people can come and drop off books and exchange books. And my daughter and my wife kind of tend to that. So your books are usually in there as well. So let me give you Dave's bio. Our guest, David McKnight, graduated from Brigham Young University with honors in 1997. Over the past 22 years, David has helped put thousands of Americans on the road to the 0% tax bracket. He has made frequent appearances in Forbes, USA Today, New York Times, Fox Business, CBS Radio, Bloomberg Radio, Huffington Post, Reuters, CNBC, Yahoo Finance, NASDAQ.com, Investors Business Daily, Kiplingers, Market Watch, and numerous other national publications. And he's been on our webinar like 4 or 5 times. Most important. His best-selling book, The Power Zero, has sold over 300,000 copies, and the updated and revised version was published by Penguin Random House. When it was launched in September of 2018, it finished the week as the #2 most sold business book in the world. For 2 consecutive years, Forbes magazine has ranked The Power Zero as a top 10 financial resource in the country. This book was recently made into a full-length documentary film entitled The Power Zero, The Tax Train is Coming. When his follow-up book, The Tax-Free Income for Life, launched in November of 2020, it finished the week as the #3 top-selling business book in the world. He and his wife, Felice, have 7 children. So again, welcome, Dave.
Thank you. Thank you for having me.
Yeah. All right. So I see some comments, and I just always have to ask, just let us know if we sound okay and if we look okay. Not generally if we're good looking, but if video is good. Okay. So again, we're really, really excited about tonight. So if you're, I hope you're registered, because we've had a waiting list now for about a week or two, and we were able to add about 5 or 6 people last night. But if you haven't registered yet and you'd like to reach out to us, we'll see if we can fit you in. But it's not only going to be great information, it's a wonderful venue. It's going to be a beautiful night. If you haven't been to the historic Newtown Theater, I think it's one of the I think it's the oldest still working theater in the country. And locally, it's a organization we support. Attleboro Wealth Management supports it, and we'll be hosting a series of movies this summer, so that's a lot of fun. But anyway, it's going to be, and Chef Joe Garvey does a great job with the food, so nothing is going to be missed about that. All right, so Dave, when we were chatting this morning, I said one of the things I want to talk about is your thoughts about the extension of the Tax Cuts and Jobs Act. So maybe we first talk about what are the Tax Cuts and Jobs Act and why you think that the deadline isn't 12/31/2025, but probably beyond. And I told you my thinking has changed since you first started talking about that last year.
Yeah.
So I'll let you take that.
Yeah. So we know that at the end of 2017, the Tax Cuts and Jobs Act went into effect, which essentially, people call the Trump tax cuts, essentially lowered everybody's tax bracket. Give you an example: the 28 became the 24, and the 25 became the 22. Okay. So everybody got a tax cut, and because they didn't get a super majority of approval in Congress. It was under budget reconciliation. They were able to push it through with a simple majority. Basically, it had an expiration date. It had an 8-year expiration date. So we know that January 1st, 2026, if nothing else happens, that those tax rates are going to revert back to what they were in 2017. Okay, which means that everybody's taxes are going to go up. Now, I've long maintained that I don't think that that's going to happen. That's relative. For probably last year or so, I've been maintaining
that's right.
That's probably not going to happen. And the reason I don't think that's going to happen is because there is a broad swath of Americans, middle-class Americans, who are responsible for making sure that all politicians get reelected. Okay. And most of those people are in the 22 and 24% tax brackets. If tax rates were to revert back to what they were in 2017, the 22 would become a 25, the 24 would become a 28. And people have really short memories. All they know is that their taxes are going to go up. And who are they going to pin the blame on? They're going to pin the blame on politicians, okay? And no politician wants to be accused or feel responsible for raising taxes on a broad swath of voters, and typically the voters that are responsible for reelecting them. So I think that if you are in the 10, 12, 22, or 24% tax brackets, there is a high likelihood that between now and 2024, they are going to re-extend those tax cuts and for another 8 years. So for example, if they were to do it this year in 2023, it would take place in 2024, which means that those tax cuts would be good through 2031. Okay. I think there's a high likelihood that's going to happen. And I think that there's a high likelihood that that's going to happen. And by the way, the 32 is going to revert back to what it was before. I don't think that if you're construed, according to politicians, as someone who is higher income, they're not going to do anything to your tax bracket. They're not going to extend those cuts. They're going to go back up. Who are they worried about? They're worried about 24% and lower. If you're 24% tax bracket today and lower, I think there's a really good likelihood that those are going to be extended another 8 years. It's a lot of posturing for election years coming up. But I think that people also need to understand the implications of this. What are the implications of this? We added on debt because of those tax cuts. And if we continue to, David Walker, I quote David Walker all the time, former Comptroller General of the federal government. Yes. He has said that we have to, in order for the country not to go broke, we have to raise taxes, we have to cut expenses, or some combination of the two. Right. So what happened in 2018 was we cut taxes and we actually raised expenses all at the same time. So we actually did precisely the opposite of what the doctor ordered. That's right. And so by extending these tax cuts and not bringing about a commensurate cut in spending, we're kicking the can down the road. The fix on the back end is going to be even more austere, even more draconian. Cuts are going to have to be even greater. You know, we can talk about Social Security. So I think that this is going to happen. I don't think it's prudent. I don't think that it's in the best interest of the country. I mean, don't get me wrong. I like low taxes just like everybody else.
Right.
But there has to be, as Reagan always said this, there has to be a commensurate cut in spending. And I don't think that's going to happen.
In your movie, there was a comment, and I don't remember the exact comment, and you'll remember, I think, who said it, but it was something like, once we've decided to spend $1, we've already decided to tax it.
Right.
Is that,
Yep.
am I saying that
That's
right?
a congressman out of California,
Yeah.
Tom, can't remember his last name, but
Okay.
yeah.
That always sticks with me because it is spending our children's future,
Right.
really. And as an American, I don't like the idea of these tax cuts being extended for anybody, really. And clearly, I'm not running for office because now I can never run for office because somebody will find that clip. And that just is, that's an example of why I believe, Dave, that these tax cuts are going to be extended to a great extent, like you were just talking about. Because as I've said, there's no courage in Washington. And we're seeing that right now. Folks, I don't know if you've heard anything about the debt ceiling lately. I'm being sarcastic. Of course, we've got about 2 weeks left before the country defaults on their debt. And Congress has seen this coming. It's no surprise, yet they're waiting until the very last minute to do it. And that's what I think, and probably Dave, and I know Dave thinks, is going to happen when we reach the point of no return. It's going to be a crisis situation in our country. Everything's ready to implode. Now they're going to come and say, we have a crisis situation, very much like we had in COVID. And now we have to take these dramatic steps, increase taxes. No one's going to decrease spending, right? But increase taxes in many, many different ways, but certainly the marginal tax rate, because that's where most of the revenue comes from. So talk a little bit, Dave, about the debt ceiling and you know, how we get here all the time and what the effect is.
Yeah, so the debt ceiling comes about because Congress needs to vote on raising the debt ceiling, and we don't have a formal structure in place that allows us to raise the debt ceiling without voting on it. And so there's a couple of issues at hand here. Number one, why does the debt keep going up? Okay, over the last 10 years or so, the debt has gone up for a couple of different reasons. We got COVID relief. We've been waging wars. We've had tax cuts that have led to more borrowing. So there's a lot of different reasons, and both political parties, frankly, are at fault for this. So there's a lot of different reasons why the debt goes up. Over the next 10 years, the debt will be going up primarily because of Social Security, Medicare, and Medicaid. Okay. In fact, in Joe Biden's recent budget, it's projected that the debt will grow by $20 trillion over the next 10 years alone. So we'll be looking at, you know, about $51 trillion of debt by the time 2033 rolls around. Ask yourself, if we stay at historically normal interest rates, how we're going to afford the interest in all that debt without raising taxes dramatically. But so the debt ceiling negotiation has come about because Joe Biden wants to raise the debt ceiling so that we can pay for things that Congress has already approved, right? These things Congress has already voted on. Yes, these things should be paid for. And then Kevin McCarthy, of course, is sort of holding everybody hostage. And, you know, again, nobody's has a moral high ground here. Right. And he says, look, we will raise the debt ceiling if we agree to long-term spending cuts. Okay. He wants to cut, you know, $4.5 trillion from the budget over the next 10 years. And where is that going to come from? It's going to come from things that Joe Biden wants to spend money on. So there's this brinksmanship that's going on, which frankly I think is unethical, where people they're playing a game of chicken. They're holding each other hostage, and they've got to figure out what they're going to do by June 1st. Yeah. And so we got 2 years. And historically, what happens is you get right down to the 11th hour. I remember I was watching once, the last time this happened, I was looking up at CNN, and there's a little countdown clock in the upper left-hand corner of the screen. It says we default on our debt in 27 minutes. Right. So that's how close it got. Yeah. And people need to understand what happens when we default on our debt. It's not pretty. Most experts say recession, if not depression. Yeah. Okay. It would send shockwaves across the world. It would, our credit rating would plummet. interest rates would go up, millions of people would lose their jobs, the stock market would crash. Our status as a world reserve currency would be called into question. People would still get their Social Security checks because that comes from a different fund. That comes from the Social Security Trust Fund.
But they say all the time the Social Security checks are going to stop.
No,
Sorry,
I
I couldn't help
that's
it.
a lot of threatening there. David Walker, Comptroller General, former Comptroller General, said it's a completely different fund. That's not what happens. People will still get their Social Security checks, but people love to throw those threats around.
Yeah.
But even if people got their Social Security checks, there would be so many dire repercussions in every other facet of the economy that's hardly a salve for all of the bad things that would otherwise be happening. So they gotta figure something out. I don't think anybody wants to default on the debt because the consequences are so dire. I mean, these guys, their job is to get reelected and to stay in office. If they let the debt, if they let that clock expire, there's no way they're getting reelected, right? So they're playing a game of chicken, and someone's gonna blink.
Well, and that goes back to, here we are 2 weeks away now. And it's going to go to the 11th hour, like you said, and there's going to be some kind of solve, but we're all going to be on the edge of our seat. They call it the fiscal cliff. It comes up, there's a term for it now that all the broadcasters use. But there's going to be a point when it's not the debt ceiling, it's everything else that's kind of colliding together. And you think that's going to be around 2030.
Right.
Do you want to talk a little bit about that timing and maybe the national debt and some other things that apply to that?
Sure. There's a couple of experts that have really tried to shine the spotlight on the year 2030. This is not opinion. It's frankly math. There's a perfect storm, a perfect financial storm that's going to happen in 2030. David Walker wrote in his book, Come Back America. This is back in 2010. He said that by 2030, tax rates are going to have to go up to 45% effective tax rates for everybody across the board to pay for Social Security, Medicare, Medicaid, interest on the national debt. So David Walker was very much a prophet when it came to predicting the types of financial straits that we would be in by 2030. So by 2030, taxes will have had to rise just to service the debt that we've accumulated. There's a guy named Brian Boileau. Pardon me, Brian Boileau is a very accomplished economist. He's in the market of predicting what the economy is going to be doing. Fortune 500 companies hire him to do the predicting for them so that they can sort of get their ducks in a row. And he's predicting that 2030 will be a depression precisely because of the types of things that we're talking about. Now, he's one economist. So is 2030 necessarily going to be a depression? No, but a lot of smart people are saying that a lot of these forces collide in 2030 and that we should get our financial houses in order before then.
Yeah.
So
interesting. Did we cover the national debt in the next 10 years to your comfort? I know that's an area that we wanted to discuss.
Well, I think that, so it took us, the debt under Bill Clinton was $5 trillion. It went from 5 trillion to 31 trillion in just 4 presidents. Yeah. So between Bush, Obama, Trump, and Biden, they added 26 trillion. Okay. And when you actually divide it between the two parties, it was 13 trillion each. So this is a equal opportunity offender here. Sure. So both political parties are at fault here. So it's not Republicans or Democrats. Everybody's at fault for the debt. The thing that's troubling though is that the thing that will be growing the debt the most over the next 10 years, we will accumulate 20 trillion. And it took us almost 23 years to accumulate that much. We're going to accumulate that much in 10 years. And remember why that is. It's because baby boomers have moved out of the workforce onto the roles of the entitlement programs. They've stopped putting money in the Social Security, Medicare, Medicaid. They're going to start taking money out of those programs. And the problem is baby boomers didn't have nearly as many children as their parents did. So we got a demographic issue. We got a demographic time bomb. And so by the time 2033 rolls around, a lot of these programs are going to be insolvent. So, Social Security goes insolvent by 2032, Medicare way before then. Yeah. Okay. Medicaid as well. So we're adding a lot of debt and there doesn't seem to be any willpower in Washington to do anything about it. I mean, we need to shore up these programs or we're just going to keep layering debt on debt on debt. And the implications for our country are pretty dire. And there are implications for people who have the lion's share of of their retirement savings squirreled away in 401ks and IRAs is likewise pretty dire because they're in a business partnership with the IRS. And as the expenses to service the debt go up, they're going to have to get more revenue to be able to service that debt. And where are they going to get that revenue from? They're going to raise tax rates, which is exactly what they've done in the past.
All right, so I'm going to go off our notes a little bit because something just occurred to me, and I get this question all the time. So with everything being so difficult and all these drastic measures having to come about with tax increases, we counsel people to move money into Roth IRAs and properly structured life insurance policies, what you refer to as life insurance retirement plans. What's to say Congress can't change and make Roth IRAs taxable, for example? And now we get that all the time, but I want to share with you to share with your viewers what your thoughts are about that.
Yeah, I mean, it's a great question. We get that question a lot
all
here. Historically, Congress has always taxed you either on the seed or on the harvest. Yes. Okay. If they were to lure you into a program like a Roth IRA or a Roth 401k or a Roth conversion and say, we are going to charge you tax on the front end, we're not going to charge you tax on the back end. And then all of a sudden they say, we are going to charge you, we're going to pull the rug out from under you, as it were, and we are going to charge you on the back end. Now all of a sudden it's a violation of a promise, okay? It would be much easier for them to say, we are either going to tax you on the front end or the back end. If you choose to put your money into 401k, we're not going to tax you on the front end, but we are going to tax you on the back end. We never really said how high that tax was going to be. That you made assumptions on your part, and we're going to do exactly what we've done in the past, which is raise taxes on everyone across the board. And they've done that. If you study the history of tax rates, it's like a roller coaster ride. We had tax rates as high as 94% in the wake of World War II, as high as 89% in the 60s, as high as 70% in the 70s. So they have a proven track record of raising and lowering taxes based on their need for revenue. So that's precisely what's going to happen. They've made no guarantees as to what tax rate. So it's going to be much more politically, I think, palatable for them to raise taxes than to pull the rug out from under people. The other thing that people have to remember is the Roth IRA is the one thing that both the government and everyday Americans love.
Yes.
Americans love it because it helps them shield themselves from the impact of higher taxes. The government loves it because it gives them more tax revenue today. So I don't know. That's why I tell people the Roth IRAs are here to stay because it's the one thing that the government and everyday Americans love.
Yeah, they're hungry for it. Every new piece of legislation is new Roth. They're now forcing higher earners to make their matching contributions to Roth 401ks.
Yep.
They've expanded the Roth capabilities for employers, allowing them to put their employer contributions into Roth options in their retirement plans. They've expanded it to simple IRAs and SEP IRA, things you couldn't do before. So don't be fooled, folks, that the government wants us to fund into these Roths. The other side of it, what I often say is they're not going to have to go after the Roth IRAs because so much is still in the traditional 401ks and IRAs, and not enough of you are getting the message or not listening to the message. Because we have these, thousands of people that we all have in our classes and on webinars, and it's still a small fraction that actually take the steps to do anything. Because I know it can be, listen, I hate writing the tax checks I have to write too, right? But I understand the value in the tax planning that I'm doing, and you just have to write those tax checks. But not everybody has the stomach to do it, and the thing is, most of America doesn't, unfortunately. And we can't reach most of America. As hard as we try, we can't reach most of America.
Yeah, I mean, there's no target on Roth IRAs.
No.
Why? Because it represents 5% of the cumulative retirement balances for Americans across the country.
Wow. I didn't know
So
that.
it's 5%, and 95% are in 401ks, IRAs, 457s, sub-simples, the types of tax-deferred vehicles. So clearly, my goal over the next 10 years is to help 100,000 people get on the road to 0% tax bracket.
I like that.
I got a long way to go because only 5% of Americans have any sort of Roth type accounts. And so that's part of my message, getting that message out that in a rising tax rate environment, I truly believe we're in a rising tax rate environment. People need to start systematically repositioning assets from tax deferred to tax free, and certainly contributing to the types of accounts like Roth IRAs, Roth 401ks, cash value life insurance like we discussed. So.
And I so appreciate what you do and what you brought to our clients and our practice and everything. It is a tough going slog sometimes because not only, and this is a reason why I do these webinars and do the classes and do events like we're having tonight, because it's not only just about bringing people kind of into the fold and the common understanding. We're fighting against decades of really misinformation. And I tell, when I talk to our staff or other advisors around the country, I often say that these annual reviews and financial planning appointments that we have for clients isn't just about review, but it's often about review and remind. Remind people why you're doing this, right? Because it's easy to fall. It's like when you drop 20 pounds and then you put 25 back on. It's easy to forget, and it's easy to get caught in the old paradigms, the old ways of thinking. So it is a constant slog. So I appreciate what you're doing. And Dave's always putting out new books and updating his books and the material. And we're going to talk a little bit about your podcast and YouTube channel, but we've got on here, we want to talk about your least favorite tax bracket and your favorite tax bracket. But first, we've thrown out a lot of doom and gloom about 2030 and higher taxes, but what's the good news?
Well, the good news in all of this is we know for sure that we have 3 more years of historically low tax rates. So 2023, 2024, 2025. So 3 years within which to take advantage of tax rates that are not likely to be this low unless they extend it for the rest of our lives. Okay. Right. The other good news, I think that they're going to extend those tax cuts for another 8 years, probably starting this year or next year. So I think that what that represents is a window of opportunity within which to take advantage of tax rates that will never, ever be this low. So if you are in the 22 or the 24% tax bracket or lower, you have this opportunity. And think about this. The 22 becomes a 25, the 24 becomes a 28. So if you take advantage of the 24, it's still lower than the future version of the 22, which is 25. So there's incredible opportunity to shield your retirement savings from the impact of higher taxes by taking advantage of these low tax rates.
Yeah, and I think I did some adjustments for inflation a couple of years ago now, maybe last year, trying to get an idea of what I thought the 28%, the top of the 28% bracket would look like. And I think I came in around just shy of $200,000 a year. Well, the top of the 24 is $364,000. So it's not just about increasing that marginal tax rate. It's also those income levels change dramatically. So that is good news. And also that we have the vehicles. We have the method. We have the ability. Congress has given us really no guardrails on how much we can convert to a Roth IRA every year. There are limitations, as you all know from listening to these webinars and going to class. There are limitations on contributions, but we're talking about conversions. You can convert as little or as much as you'd like. And all you have to do is decide how much tax you want to pay, not be told, here's your situation, now pay that tax. So we have the time and we have the resources to do it. So it's really exciting. Okay, so now let's talk about your favorite tax bracket and let's talk about your least favorite tax bracket.
Okay, so a lot of people say, Dave, what's your favorite tax bracket? And they think that I'm going to say zero because that's the title of my book, The Power of Zero, that refers to the 0% tax bracket. My favorite tax bracket is actually the 24% tax bracket. And the reason I love the 24% tax bracket is because it's only 2% more than the 22, but it allows you to convert an extra $170,000 or so to tax-free.
Right.
It only costs you 2% more on the margin. Now, if I were to say, hey, look, you're currently in the 12% tax bracket, you need to convert $200,000 and in the process bump up to the 24% tax bracket. What am I basically saying? I'm saying, look, tax rates are going to double. Let's protect you from a doubling in tax rates by doubling your tax rate in the short term. That's not a message that people love to hear. But if I said, hey, look, tax rates potentially could double. You're currently in the 22. Why not convert to the top of the 22? And oh, by the way, the 24 is only 2% more, and it allows you to convert an extra $170,000 along the way. Why wouldn't you want to do that? I think the 24% tax bracket is the sweet spot in the Trump tax cuts. And I think that, for sure. And it's like I said before, the 24 is still lower than the future version of the 22, which is 25. And the 24 becomes 28, the 22 becomes 25. So 24 is, I think, an opportunity that if the situation is right, you should really take advantage of it.
Yeah. Yeah, there's a lot of room there. And you know, we've talked on our last webinar, we talked about this a lot, and that was just a couple months ago, I think. I'm so fortunate to be involved in these two great groups, and that's Ed's Master Lead Advisor Group. You know, you were there with us in Washington, 430 or 460 right. Now, some people. And not only is Ed brilliant, his team is great, very, very sharp. There's a lot of power, brain power in that room. Sometimes you have conversations with people and they just blow your mind of how they're thinking and what they're doing. But every time we get together and we talk about it, it seems that the average middle class American is going to end up in the 40 to 45% effective tax rate by the time this is all said and done. And that's a significant jump, and it's unimaginable, unfortunately, for so many people. And it can be significantly changing for people and really affect their retirement in a very negative way. Or you know, you have to give your money to the government instead of your kids or the people you want to, whatever drives your excitement about this. But
and by the way, I recently did a video where I looked at Denmark, who has 50% tax rates. Yeah. And I said, what is it like to pay 50% tax rates in Denmark? And you know what you get in Denmark? You get universal health care, you get sure. paid sick leave, you get paid maternal leave, you get all of these goodies in exchange for that 50% tax rate. When our tax rates go up to 50%, what are we going to get? We're going to get nothing.
That's true.
Except for service, that 50% is going to go to service the national debt, because that's all we're going to be able to afford at that point.
That's a good point. You know, I was in Iceland in February, and I've told this story on the webinar before, but we were on a food tour. And if you go to, first of all, you should all go to Iceland if you can. And it's a really neat place to visit. And they have these walking food tours. And the tour guide was telling, a really wonderful young woman, she was telling us about how wonderful, we were talking about tipping, because you don't tip in Iceland. People got a little offended when I tried to tip. Mm-hmm. So I was asking her about that, and she said, well, because we all make a good wage. Mm-hmm. And she was saying how she's had friends come to stay in Iceland for a while, because you can't really immigrate to Iceland. You can come work for a while because the wages are so great. And I said, well, as a good financial planner, I said, well, what are your tax rates like? And I can't remember the brackets, but I think she said there's 3 brackets, and it starts at 30 something, mm-hmm. goes up to 40 something, but everybody pays 30 something. And then as you progress in wages, you progress in tax, but it ends in the mid 40s, I think it was. That is so different than what we have, right? Because still half of the country doesn't pay any tax. Right. I had this conversation with my son, my youngest son, and he said, well, I pay tax. He works for us. I pay tax. I said, yes, but you get it all back at the end of the year. But he said, but I still pay it. I said, no, that's not how it works. You get a refund. Your tax rate is still 0. He didn't. He's come around.
He's experiencing the power of 0. Huh?
Yeah, that's right.
Yeah. Well, you know, and he may also say, but I pay FICA tax. I pay 7.65% for my FICA. Mm-hmm. To which you may respond, well, you're going to get that back too at the end. Well, in theory, because of Social Security, right?
That's right. That's right. Yeah. So you're right. You know, there's a lot of great things they get for their tax rate in Iceland. They get very safe streets. They have 100 people in jail. You know, it's really interesting in the whole country. But great healthcare. They talked about 90% of your healthcare is paid for, living wage, all those different things. But when we get there, it's just going to be to catch up. It's almost like, you know, having to catch up on credit card debt. Actually, it's exactly
what it's a national credit card. Right?
Yeah. All right. So did we talk about your least favorite tax bracket?
No, my for least, most people. Yeah, for most people, and there are some exceptions here. So I'm going to give that caveat. Mm-hmm. But what I don't want to see people doing is saying, okay, 2026 is coming around, and so I've got to get all my Roth converting done before 2026 rolls around. And so what do? They bump up into my least favorite tax bracket, which is 32. 32 is what you hit if you go above and beyond the 24. So it goes 22, 24, 32, 35, 37. I hate seeing people bump up into the 32 because they think they got to get all the heavy lifting done before 2026. Because guess what? Your 24 becomes a 28 after 2026 if they were to not extend everything. And that's still lower than the 32, right? Yeah. So stretch that tax obligation out past 2026. You'll still stay in the 28% tax bracket, don't preemptively bump up into the 32 because you think you got to get all the heavy lifting done before 2026. Under no situation really do you do that if you've got this finite amount of assets. If you've got 10 million in your IRA and you're a high tax bracket, maybe that makes sense to do it.
Yeah.
But for people that have normal level of assets, it does not make sense to bump up into 32.
You know, and that's really the art. That's where I often say there's definitely an art to it, because you've got to look at projections. You have to look at required minimum distributions. You've got to look at the spending distributions and what your tax bracket is going to be, either just from your desires or forced by the IRS. And so, you know, we're fortunate demographically, even around the country, our clients have a large amount of assets often in IRAs, and it takes a lot of work to get these done. But yeah, everybody's different, folks, and you've got to go through that financial planning process to determine what's right for you. All right. So Dave, you talked about, and I think do we have a question or two? Do you want to take a look at questions?
Sure. So when liquid cash resources are not abundant, what are your thoughts on withholding taxes upon making a conversion to Roth?
That's from Jerry. Hi, Jerry. Jerry's a regular, and I think Jerry's going to be there tonight. Jerry's a retired IAR, a registered rep.
So when liquid cash resources are not abundant, what are your thoughts on withholding taxes upon making a conversion to Roth? Yeah, I mean, you're going to have to. The ideal is to pay a tax on a Roth IRA or on a Roth conversion from an account other than the conversion itself, right? So there's really two ways of doing it. You pay the tax out of a taxable bucket, which is really the ideal, because your taxable bucket is your least efficient of all your buckets.
Right.
So your idea would be to sort of spend that money down first and use that as a catalyst to get the entire Roth conversion into the tax-free account. So what do I think about it? Well, if you don't have enough money in the taxable bucket to be able to pay those taxes, that's your only other choice.
Yeah, listen, mathematically, it makes sense to pay the tax out of the taxable bucket. But if you don't have it, then withholding is just fine. Psychologically, withholding works for a lot of people because they don't see the tax money that goes. What people don't realize is that when you withhold tax, you often have to, account for the additional tax on the withholding too, right? So you've got to calculate that in. Mm-hmm. So it can really add up, and what it does for most people is dramatically reduces the Roth amount, the Roth conversion amount. But it's okay. It's better than nothing. It's better than not. Right.
There's another question from Doug.
Yeah.
Do you foresee any changes where states would tax Roth IRAs? State budgets are also challenged and must have balanced budgets. Yeah, so the difference between a state and a country is states don't have the ability to print money. Mm-hmm. So they, if they overspend, then they have to raise revenue, and they're probably going to be looking in all quarters. A lot of these states have unfunded obligations for pensions, particularly California, Connecticut, New York, Illinois. So they promise way more than they can afford to deliver for these pensions. So my thought has always been, as states and countries slide into insolvency, all options are on the table. I think it's unlikely, but I think that all options are on the table. Nothing surprises me at this point, honestly.
But I had to tell you, Doug, I don't think they're going to have to. Again, as Dave pointed out, only 5% of the retirement assets are held in Roth IRAs, and most people have a tremendous amount in their traditional IRAs, and that's for many states that's still fully taxable. A lot of states have exclusions up to a certain amount, like New Jersey. Pennsylvania is a pension-friendly state, which means there's no tax on pensions or qualified IRA distributions, but you've heard me say it, Doug, that's likely to go away in the next decade. I've talked to state legislators, and if you had them secretly in a room, they would tell you that it's not affordable. Something has to change. We have a significant pension deficit, and in Pennsylvania, you've all heard me talk about this. When I started on the school board, our contribution that we had to send to the state was $5 million. I thought that was a lot until a couple of years later. It was $32 million. And they said, that's okay. That's going to level off. And they lied, because by the time I left, it was about $37 million. So good question.
And that's another reason to take advantage of Roth conversions while you can. I tell people in Illinois all the time, because they got the same deal. Illinois is even worse off than Pennsylvania.
Oh, yeah.
By a long shot. So take advantage of the zero tax on a Roth conversion from the state level while that's still around, because who knows how long it's going to last.
And plan. This is another planning point. So I just had a client who bought a house in South Carolina, and I said, okay, they didn't. It wasn't part of the discussion. It was kind of a last minute thing for them. And I said, all right, so how are you going to handle residency? And he said, well, we sold our house here. We're moving down there. I said, okay, now we got a plan for state tax on your Roth conversions, and it wasn't on his radar. So I think that's probably about a 6% rate. Maybe a little bit more. So be aware of those things when you're thinking about where you're going to live and how you're going to handle things. Okay, really great questions. All right, Dave, you talked about financial gurus and why you don't like financial gurus as a whole.
Yeah, that may be the topic of my next book. Yeah. So there's let's talk specifically about there's three people I typically talk about: Dave Ramsey, Susie Orman. There's a new guy named Ramit Sethi who just did a Netflix series called called How to Get Rich, based on a book that he wrote back in 2009 called I Will Make You Rich, or something like that. I will help you to get rich, or something like that. Anyway, so what you find with Dave Ramsey is they got a lot of good stuff, particularly for a broad swath of the country that spends more than they take in. So if you're making 50 and you're spending 60, Dave Ramsey's your guy. Total Money Makeover, great book. Susie Orman's got some great stuff for getting out of debt. Ramit Sethi dedicated a couple episodes in his Netflix series to people that are drowning in debt. Great ideas. Ramit Sethi's got some great ideas on spending money on the types of things that are meaningful to you in life. So, for example, he drives a Honda Accord, but he always flies first class. So he spends the money on the types of things that make him happy, which I think is great. I think it's good advice. However, part of what you see, for example, with Dave Ramsey is Dave Ramsey wants to be all things, all people. And so what he tends to do is he tends to give these really general one-size-fits-all prescriptions, okay? And he paints everything with a really broad brush. So for example, Dave Ramsey, because he's got this huge audience, he doesn't have the luxury of nuance. He doesn't have the luxury of saying, well, it depends on your situation. So he tends to make these broad sweeping generalizations. For example, when it comes to annuities, which academia has been studying for years, there's mountains of evidence that show that annuities, the right types of annuities, can extend the life of all your other investments. Life insurance retirement plan, there's reams of data. There's a recent Ernst & Young study that talks about how life insurance can, particularly when used as a volatility buffer, can help increase your sustainable distribution rate in retirement if you take money out of your life insurance in the year following a down year in the market. So there's a lot of really compelling studies that academics have done on these types of things that Dave simply doesn't acknowledge. And so because he's got the one size fits all prescription and he paints everything with a really broad brush, he doesn't have the luxury of nuance. And so he has to take a black and white position on it. And when he takes that black and white position on it, you no longer have the ability to have a tailored, customized financial plan. So the people that are studying Dave Ramsey or Susie Orman or Ramit Sethi, they all have the same sort of issues. You have to try to cull from their advice the things that fit your specific financial situation. And it's nearly impossible, if you have substantial wealth, to try to make heads or tails of what they're telling you. And so what you really need is you need a CFP. You need someone who has been down this road before, that understands how to look at your specific situation and give you advice on how to wring the most efficiency out of your retirement dollars. And part of the issue is that Dave Ramsey started off as a guy that helps people get out of debt, but he slowly branched out into all of these other areas and takes positions on black and white positions on things that have nuance. And I think a lot of people are the worse off for it.
Yeah. I know a person who is a Dave Ramsey disciple, and he repeats these, they're almost like mantras that they have about life insurance and leases. And he went on and on about car leases. Now I buy my cars. Jessica, our office manager, she's been with me now 15 years. She's had at least 5 cars in that time, right? She likes a new car every year. If she was buying a car, or every 3 years or so, and actually, it's usually shorter than that now because they entice you to come back. But if she was buying a new car, she would have lost money on that. right? So that works better for her, and it doesn't work for me. And there's a lot of reasons that I have for that, but yeah, that's just one example. But my goodness gracious.
So another example, just briefly. Somebody called in to a show and said, "Hey, look, I got all this other extra money in my savings account. What should I do with it?" He said, "Well, tell me about your house mortgage." He's like, "Well, I owe $100,000 on it." He said, "Well, pay off your house." Well, so mathematically speaking, that doesn't make sense. If you have a house at 3% and it's tax deductible, it's really costing you 2%, right? So 2%, that's pretty cheap money. So if you take money that you could have otherwise invested at 8% over time, and you use it to pay off a debt that's only costing you 2%, there's a 6% arbitrage, which if you amortize that out over the balance of your life, it's going to cost you hundreds and hundreds of thousands of dollars. Well, what was Dave Ramsey's justification? He says, we've studied all the rich people, and rich people pay their houses off.
Yeah.
Well, rich people pay the houses off because they have the luxury of paying their houses off.
Right.
When we're talking about people that have fewer assets, where picking the right strategy really makes a difference over a long period of time, that's not the right move.
Yeah, and it's also not true.
Right.
Yeah, there are many, many wealthy people who understand the difference between paying a 2.5% mortgage and getting 4.5% in a 3-month treasury bill right now.
Right.
So you do have to take into account that risk-free rate of return when you're looking at those things, or being comfortable with that arbitrage, that difference between the 2% and the 8% that Dave was talking about over time. But my goodness, that person could have been 25 years in a 30-year mortgage, and the interest is like minuscule. Who the heck knows?
So why does he take this position? He has to take the position because he has to have a formula that people can apply to their situations. And if he says, well, it depends on your situation, now all of a sudden he's not in a position to advise them.
Yeah, he
has to have a one-size-fits-all strategy. Or if you invite nuance into the picture, people are going to be like, oh, I guess I need a financial advisor. Yeah. I can't rely on Dave Ramsey anymore.
And he does have those coaches out there, right? So those Dave Ramsey coaches, which are kind of like, anyway, I forget where I was going now. Do you have anything else to say?
No, pretty much, I'm done slamming the gurus. So,
all right. So I want to talk about what's new at the Power Zero. So folks, this group gets better every single year. We had a great conference that I attended with Dave and Ed Slott. And how many people did you have in Miami?
I think we had about 100, something like that.
Really, again, like Ed's group, I'm just so impressed with the caliber of people that are involved in the Power Zero, and I like the mastermind group you just started. That's beneficial. But what's new at the Power Zero?
Well, really, the big thing is that about a year ago, I started a YouTube channel, and I put out 3 videos a week. So if your viewers want to go subscribe to that, that's always welcome. And I'm talking about everything. I'm talking about the fiscal condition of our country, how to insulate yourself from the impact of higher taxes. I talk about I take on the likes of Dave Ramsey, Susie Orman, Ramit Sethi, Clark Howard. I do specific videos on things that they say that I think are off base. I talk about the white coat investor. He's also a guru that I love to spar with. I talk about...
Yes, you do.
Yes, I do. He's one of my favorites. We actually went to the same school out in Utah, so we belong to the same church. So I feel a little uncomfortable. But when you say stupid things, you're gonna get a retort from me. That's for sure. So that's really taken a lot of my time. Is I love sort of scouring the financial landscape and seeing what's coming, and trying to warn people about how they can best shield themselves from what I think is going to be financial calamity in the next 10 years. We're at a point in our country that I mean, you can make the case, well, it was bad in the 70s, bad in the 80s, bad in the 90s. You can always make the case that things were bad. I think that this decade is different. The coming decade is different. And people say, David McKnight, Ed Slott, you've been warning about tax rates going up for years, and they've actually done the exact opposite. Well, guess what? Why have taxes gone down? Out of political expediency. And what has the national debt done in the meantime? It's spiked dramatically. So we're at, the good news, I think, in all of this is that we have a period of time of historically low tax rates, and we can take advantage of those tax rates before tax rates rise dramatically. So I talk about all those things on my YouTube channel. My podcast, same thing, every Wednesday comes out. So really, we're just trying to get the message out in a variety of ways. And once again, our goal is to help 100,000 people in the next 10 years get on the road to the 0% tax bracket.
That's exciting. You'll do it. you'll do it. You've got a great network of these Power Zero reps, and representatives like myself. And I always hear you wanting more, and I'm always coaching for more people to join. I've got a great group of people who were part of my CFP study group way back in 2011. I talk to them about it all the time. Folks, if you haven't listened to Dave's podcast or Dave's YouTube channel, go in and set yourself up for notifications there. Also, I listen to them all the time. I tend to catch up on your podcast as I'm driving because they're nice and short, by the way. What about 15 minutes or so?
Max,
yeah. But great information. And I'll secretly tell you that sometimes I might be inspired by something that Dave says on his YouTube or podcast, and you might see it again on our Tuesday weekly webinar. But that's okay. I think Dave's probably done the same.
No doubt. We all do it.
Yep. Okay. Anything else you want to talk about today?
I don't think so.
Oh, well, let's talk about what folks should be doing now.
Yeah. Well, I mean, I'm going to sound like a broken record, Mark.
Yeah, that's okay.
I'm going to really sound like a broken record here. What should you be doing now? You should be really asking yourself the question, should you be doing Roth conversions this year? If you're currently in the 22% tax bracket, there's a pretty good chance you should be converting to the top of the 22% tax bracket. And by the way, 24% is only 2% more. So if you feel good about the 22, you should likewise feel good about the 24, because for 2% more, you get to shift an extra $170,000. Let's face it, folks. If you've got $1 million or more in your IRA, you are not going to be able to get all that money shifted to tax-free by staying in the 22% tax bracket. Only by availing yourself of the 24% tax bracket and an extra $170,000 per year that you can shift to tax-free will you ever be able to pull this off. And so I think that what people should be doing now is taking stock of how much money they have in each of their buckets: taxable, tax-deferred, tax-free. And I tell people this all the time: taxable should have 6 months worth of basic living expenses. Okay, just enough to cover an emergency. Tax-deferred, you want that balance to be low enough such that required minimum distributions in retirement are equal to or less than your standard deduction, but also low enough that it doesn't cause Social Security taxation. And then everything above and beyond those ideal amounts should be systematically repositioned to tax-free. You want to shift that money slowly enough that you don't rise into a tax bracket that gives you heartburn, but quickly enough that you get all the heavy lifting done before tax rates go up for good. So I think that's my farewell parting invitation here, is just to take stock of what you have in each of your buckets and make sure that you're on track to have the ideal amounts in each of those buckets.
Yeah, and I'll just add, folks, you can try to do this alone if you want. Dave and I were just talking. He has a similar experience with other advisors throughout the country, but I have story after story after story of people who start down this road on their own and get IRS notices, or they overpay for something, or they're getting bad advice. They try to piecemeal it together, and it just doesn't work. So give it a shot if you want, but if you just want to start the right way, just engage a qualified financial planner who focuses on this kind of work. It always is funny to me when people come to meet with us and we show them, often the millions of dollars that we bring to them, or could bring to them over their lifetime if they just do things a little differently. And then they'll say, okay, well, I'm going to take this to my person who never discussed this with me before. But that person doesn't specialize in this kind of work. So it's important to put your team together, is my point. You want your qualified, certified financial planner. I think, in my opinion, your financial advisor should be a certified financial planner, and he or she should specialize in this tax efficient planning. Ideally be part of Dave's group or Ed Slott's Master Lead Advisor group. You want a good attorney on your team, an estate attorney. Even if you're not elderly and you still have elderly parents, you probably want that person to also be an elder law attorney. And you want a CPA. I think you certainly want an accountant. That's another one. Time and time again, people say, I do it on my own. Unfortunately, we had a client who we introduced to an accountant. She decided not to engage that accountant because of the fee, and she made a tax mistake that cost her about $10,000 in unneeded tax. And that's unfortunate, and those things happen all the time. So you want a good accountant, and that accountant, I think, also should be a CPA. CPAs have that certified training and testing and experience and ethics requirements. That's very important. So, folks, that's what you should be doing now. But most importantly, what you should be doing now is getting ready for tonight and coming to the Newtown Theater and seeing Dave and Ed Slott and the rest of us. My team's excited. Even my employee from Florida, Himiko, is probably on her way from the airport right now to join us. So we're all excited to see you. And I'm excited to have Dave here live. And I hope this was beneficial. I think we may have a question or two.
Couple more questions.
And then we'll wrap it up.
From Kathy, your outreach and education, Mark and David, is really appreciated. Thank you.
That's nice.
Walter says he seconds that. Joseph says, if you take an RMD from a 401k or traditional IRA, do you need to wait a certain amount of time before investing that money into a Roth?
If you take it, unfortunately, you cannot invest an RMD into a Roth IRA unless you could otherwise have that as a contribution.
It's got to be a contribution.
Yes.
You can't make it part of your conversion, but you could certainly take that money out, deposit it into your account, write a check,
correct,
fund your Roth IRA. There's no problem. I'm not aware
if you can make a contribution to a Roth.
If you're able to. And by the way, if you're married, that phases out fully at $228,000 modified adjusted gross income. And we were talking about this beforehand. Your Roth, any amount that you Roth convert does not count towards that $228,000 in modified adjusted gross income threshold, but there's no time limit that says that you got to wait a certain amount of time before you can take that RMD and then turn around and deposit it into a Roth.
Yeah, but I just that's a tough one, Joe. Dave's right, everything he said, but there's a lot of nuances to that, so be careful. But good points and good seeing everybody. Or on the screen, and I hope you enjoyed this. I hope it was beneficial. We'll see you next week for next week's webinar, and hopefully we'll see you all tonight. Take care. Have a great day.